3.
Thank you for joining us this afternoon. Today is Wednesday, March 25th. I'm Joe Terril, president of Terril and Company, independent wealth managers in St. Louis, Missouri, with approximately $775 million of discretionary assets under management. We will be talking about the world economy and what our outlook is for it, as well as our updated outlook for investment markets. As always, helping me today is Brian Curtis. And Brian, if you're ready, maybe let's move on to discussions about the world economy.
Okay.
Our outlook for the world economy is constructive. It is not getting ready to fall apart. We're not getting ready to see the world go into a severe recession, etc. There are troubles around the world. There are issues out there to be dealt with. One of the things that I like to talk about, because I think this is potentially a major issue, is the fall in the price of oil, which has really been orchestrated by OPEC's refusal to cut production, which they've done for 40 years, which some people are saying is trying to discourage hydraulic fracking, excess production of oil in the United States. We don't go with that at all. We believe this is a move by the entire civilized world, as well as help from the moderate countries of OPEC, in order to try and bankrupt Russia and or cause a regime change from Vladimir Putin to perhaps somebody that's a little less aggressive in trying to create instability around the world. And when this happens, which we think it will, it's going to be very interesting to see how the balance of the world reacts and what, if any, repercussions it may have on the European economy. I think that depends really upon if Vladimir Putin just disappears one day because he's bad for business, and certainly 100 or so families that control almost all the net wealth in Russia, he's costing them a lot of money. Or will this drag on? Most estimates are Russia has maybe 12 or 15 months worth of foreign reserves left before they run into a real issue about how to continue to support the country. So with most of their wealth coming from energy, it would be very successful in driving the price of energy down to the point where it'll bankrupt the country or, as I say, cause this regime change. With a bankrupt Russia, much more so than Greece, we'll have to see how that's going to affect Europe. But with that being the wild card that's out there, growth around the world is okay. It's not fantastic, but it's okay. Europe is doing better. The United States continues to muddle along with maybe 2% real GDP growth. China has slowed down, but I think that's a matter of large numbers. As the Chinese economy has grown over the last 10 years, 7% growth, 6% growth on an economy 5 times as big as it used to be 10 years ago is better than 15, 20% growth on a smaller economy. So the people that perhaps worry about the Chinese economy slowing down, I don't think they're putting it in proper perspective. So we are mildly bullish on the world economy. We'd like to see less governmental regulations, particularly within the financial industry all over the world. That would help the economies expand a little bit. But let's go on now, Brian, and perhaps let's talk about our outlook for investment markets for the balance of 2015. It's a fascinating time to observe investment markets, particularly in the United States, and the reaction to the difference in interest rates around the world and the movement of capital around the world. In general, because we still have positive interest rates in the United States. And I say that meaning that, as most of us know, there's actually negative interest rates in many places of the world. Therefore, people are selling currencies where there's a negative interest rate, converting to dollars to be able to invest in the positive interest rates in the United States. This is artificially holding down our interest rates. A 10-year government bond right now is at 1 7/8%, United States government bond that is. This is causing the dollar to be up in value, which is creating an environment going forward where we'll very likely see flat to negative corporate earnings. This comes about because we went through a 10 or 15 year period of a very weak US dollar. So as corporations made sales overseas and that money was converted into US dollars, it bought more and more dollars, which made their earnings appear to be higher than what they actually were. We're going to have the opposite this time. For the next few years, as corporations sell overseas, it's going to create less dollar earnings. So it'll be very fascinating in the next 6 months to see just what effect that this stronger dollar is going to have on reported corporate profits. Add to that equation the fact that even though most corporations are multinational, dealing in almost every country in the world, you'll still probably see at the margin some sales lost by US denominated countries to countries where the currency is cheaper. An easy example of that would be that perhaps a buyer would maybe buy chemicals from a German company rather than from a United States chemical company, because the currency would make it cheaper to buy from them. So with these things put together, that's sort of a negative for the markets, and the markets are concerned about this, and we see days where the dollar is strong in trading, therefore the stock market's off 200 or 300 points. We also see concerns about interest rates in the United States perhaps going higher, which would even encourage the dollar to be stronger. But the Fed at a recent meeting threw a little bit of cold water on that, and I want to add to that equation, it is not for certain that our Federal Reserve is going to be able to raise rates even if they want to. And this comes about because of a massive amount of central bank liquidity that's been supplied to bank balance sheets. I'm not sure if the Fed's capable of draining that much money from Federal Reserve bank balances with the Federal Reserve to actually cause short-term interest rates to be able to move higher. And certainly I don't believe the long-term rates are going to be able to go any higher, because there's too much capital out there right now that wants to buy our bonds whenever the interest rate goes up a little bit. Witness the fact that for the last 6 months, with all the talk about US interest rates going up, yields on any type of longer term high grade bond continue to fall in line with the rest of the world. So even if the Fed is successful in raising short term rates, I don't see long term rates going up in any manner to make a major difference. But we do have these concerns in investment markets of the dollar going higher, corporate profits perhaps being flat to lower, world economies muddling along with 1 and 2% growth. All of these things would call on a fundamental basis for investment markets to be lower in price. And we see this in the markets where it seems like one day the market's down 300 points, 200, 250 points. And then within 1 or 2 days, we see the opposite side of the equation, which is prices turn around and markets go up 200, 250 points. This is being caused from a very simple scenario of what Wall Street has nicknamed TINA, as if it's a girl's name. And TINA is an acronym that means there is no alternative. And to a certain extent, that's very true. There's nowhere else for world capital to go and for world capital to flow. It's got to go somewhere. And you see a pullback in stocks, and about time you do, you see buying coming in, and prices are right back to unchanged. So as we sit here on the 25th of March, for the entire year, investment markets are pretty close to flat. They're not up, they're not down. The tug of war continues. I think this will last throughout this year. By the end of 2015, I think bond prices will be very little changed regardless of what the Fed does with short-term interest rates. And I think stock markets, equity markets will be, maybe up 1, 2%, maybe down 1 or 2%. I don't see a big move one way or another. This stalemate will not change until we see the world economy pick up enough that it can create demand for capital around the world to create an alternative to investment markets for world capital. In other words, we need loan demand. We need to create a scenario where people around the world want to borrow money because there's enough economic activity that they can make money with what they borrow. So in general, our outlook is for markets by the end of the year to be very little changed. We tend to favor foreign markets more than the United States market, and would expect to see better gains in foreign markets. They're certainly cheaper, lower priced right now, which means they're more attractive, and do believe that sales around the world, particularly of commodity type products, favors foreign countries over the United States. Therefore, we believe their markets look a little bit more attractive than domestic markets at the moment. Brian, let's sum it up and we'll go on.
Okay.
Thank you for joining us this afternoon on our bi-monthly update on our outlook for the world of investments, economic activities, interest rates, etc. Once again, my name is Joe Terril, president of Terril and Company, independent wealth managers in St. Louis, Missouri. And we will be back as events warrant, or we will be back with an update maybe as market change calls for it, or fundamentals change enough that our opinion may change. Either way, we thank you for joining us and wish everybody a very happy Easter season.